Happy morning, friends. I am Sudarshan for your PV Wealth Creators Investment Bytes. Nice to be connected with you again through this YouTube channel. Actually, I have not posted the videos for last 4 or 5 days because of my throat infection. I am not able to speak actually. That's the reason I have not posted videos. And I got a lot of feedbacks from my industry friends, actually, people who are colleagues who do financial planning like me. Actually, they all said you have to put a current topic in this channel so that people will understand and follow you, kind of thing. But I told them that that is not the purpose of my channel. Because if you look at current scenario which is happening in the market or all those things, that is covered by a lot of people in YouTube channels. If you because predominantly they focus towards equities, share market, what is happening in share market and all those things. That is not purpose of this channel. Basically, the purpose of this channel is to create awareness for people how to make financial decisions, not mess with your financial decisions. So that is the purpose actually. I'll tell you how people are messing up with a financial decision is wherever I see people have invested money into lot of life insurance plans without knowing about what is this plan and how it will get matured, how this will be very useful for my financial goals. All those things was not there at all. So that's the reason which made me to create this channel and put postings. So, as a first step, I am making you to understand what are all the possibilities, what are all the futures, what are all the options available in the market, and how to the days coming by, I will be explaining you how to choose products for various needs. So that is what I want to clarify. Then. Actually, the next thing I would like to cover is debt is what we are in a discussion. In between two videos, I've put in current market scenario kind of thing. But now we are back onto track. Basically, I've covered two things. One is liquid fund, another is overnight funds. So these two things I've already covered. Before covering the third thing, one important thing I would like to share with you in this video. One is basically we normally say if we talk about debt, it is basically a tradable. Even though it is bonds, we call this as tradable bonds actually. So what is the difference? Even compare between fixed deposit and bonds. What all the futures is available in fixed deposit, same thing is available with your bond also. See, fixed deposit has a capital and it has interest, so and there is a maturity. Same way, your bonds also have capital and there is a interest. Interest is nothing but we technically call it as coupon, and it also has a maturity date. So all these three things are available, but only the difference is to create liquidity to the customers and the persons who are investing. To create liquidity, these bonds are tradable in the market. So obviously, if it is tradable in the market, people normally used to think how the price is decided. Basically, the price is decided because of one thing is based on the interest rate. So this interest rate normally keeps on changing every day. When the market is there, it keeps on changing. How there is a equity market, there is a bond market which is there. This bond market is the price deciding factor is your rate of interest. This interest, that is coupon. Technically, we call it as coupon actually. This coupon rate will be changing as and when the trading is happening. So how this is decided? It is based on the demand and supply. There are a lot of borrowings happens from government side. There are borrowing happens from the corporate side. So based on the demand, if demand is high for loan, there are a lot of people asking for a loan. Loan is nothing but issuing bonds. That is, if there are a lot of people is there in the market to buy these bonds, then demand to this will go up. So automatically the interest rate goes up. So if the interest rate goes up, automatically the bond prices will come down. These are inversely proportional actually. The bond prices comes down actually. So if interest rate is coming down, the bond prices goes up. That is the relationship between the interest rate and the bond price. So based on this only, the fund managers, debt fund managers, they must be having how equities they have a view based on the economy, based on the demand and supply. These people also have views on the interest rate. Based on that, people will the fund manager will choose the fund. So on that only, I told you why I am telling you this right away is on this juncture is because the liquid fund and the overnight fund will not get into this type of trading risk. So this will not get into that trading risk actually. So other funds which are going to follow from now on, from tomorrow's videos, the trading risk will be applicable to these funds. So happy living, friends. Thank you very much for watching this video. Please be sure to know about a lot of things from tomorrow onwards. Please subscribe for my channel. Subscribing is free of cost for you. YouTube will not charge anything to subscribe. There will be when you watching my a video, on the right corner there will be a subscribe button on a red color. You just click that, it will subscribe for my channel, and there is a bell symbol after that. If you click that, as soon as I post video, you will be getting a reminder. There is a alarm will be coming to you, so that you will not miss my videos. Thank you very much, friends. Again, happy living. Good day.